With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to the Virtual Roadshow series presented by ChannelChek. This roadshow features Damon Hininger, President and CEO, and David Garfinkle, EVP and CFO of CoreCivic, NYSE ticker symbol CXW. Following a formal presentation, they're joined by Joe Gomes, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Noble's research on CoreCivic on channelchek.com or by clicking the link in the description. With that, I am pleased to present Damon and David.
Well, good afternoon, everyone. Thank you for joining us this afternoon. It's a beautiful summer day here in Brentwood, Tennessee, and so hopefully you've had a good summer, but able to take a little time and learn about CoreCivic. It's a real honor for us to spend a little time with you this afternoon. So I am Damon Heinecker, President and CEO of CoreCivic. Dave Garfinkle is our CFO. I'll let him introduce himself a little more formally here for a second, but I've been with the company just about 30 years. Actually, May next year will be 30 years with the company and about 12 years as CEO.
So I've been with the company, just hit my 20th anniversary, and in my current role since May 2014, and the CFO role since then.
Outstanding, outstanding. Well, let me first just say thank you to Joe Gomes and the Noble team. You guys are just fantastic, and we again appreciate this forum to educate a few folks about CoreCivic and the really, really important work that we do for government. We're going to spend a few minutes going through a slide deck that you see there on the screen, and if you want to spend a little more time with this afterwards, it is on our website, CoreCivic.com. It is our Q1 investor presentation that we typically do at the end of each quarter. So this is Q1 2021 investor presentation that we'll spend a little time with. So with that, start here on slide number 2. Gives you a nice overview of the company. So just in round numbers, we do about $2 billion in revenue, have just under $4 billion in assets, and nearly 18 million square feet of real estate as of 3/31 of this year. And you see there in the bottom left, we do really 3 key things, starting from left to right. On the left, we do what we call CoreCivic Safety, and this is where the company was founded nearly 40 years ago, which is a solution where we own the real estate, so the prison, jail, detention center, and we provide the service. So the warden down to the correctional officer, the detention officer, or CoreCivic employee. So a real turnkey solution where we do the development, we own the real estate, we provide the services to the government. So again, that's what we call CoreCivic Safety. And as you'll see here in a slide, couple slides, that's the majority of our business. This is a great overview of the company. As you see there on the bottom left, we've got the safety, properties, and community business lines. I think you probably heard a little bit about the overview of those three areas, but just a quick highlight on properties. Again, that's a relatively newer solution. We started that in 2012, where we own the real estate, we maintain the real estate, and government is the operator. And there on the right, community is another relatively newer solution, where these are reentry facilities that we typically own and operate. There's a few where we own and we have a partner with a nonprofit who operates, and these are typically in metropolitan areas providing reentry solutions and services to people that are probably 6 to 12 months before they get released. So reunified with family, gainfully employed with the employer are kind of key parts of that mission for those facilities. And again, you probably heard me on safety, but just a quick headline there. That's where the company was founded. Those are facilities where we own and operate the facilities. So not only do we own the real estate, but we provide the services. So a real turnkey solution. Going to page number 3 there, this is a great visual of the company. May have heard earlier, but we are focused purely on U.S.-based operations, so we don't do anything internationally. And then there on the left, you see a breakout, a little bit of the numbers, again, by the 3 segments: safety, properties, and community. Probably important to know, too, as you think about our size, which is really, really large. I mean, we're one of the biggest private owners of real estate used by government. But in the grand scheme of things, majority of the criminal justice facilities in the United States at the federal, state, and local level, over 90% of that is still government owned and operated. So our total industry with us and a couple other private companies is only about 7-8% of the total capacity in the United States. And then going on to page number 4, another great visual. Notably, this gets a good overview of the business mix between the 3 business lines. Again, the vast majority of our earnings performance comes from the safety, but also we do see growing growth in a percentage perspective on the property side. The community is smaller. These are typically smaller facilities, but they're great mission. Again, helping individuals right before release on some of those key services and get reunified with family and gainfully employed. Paint a little bit of an umbrella on these 3. All of them touch government, so that's probably obvious, but everything that we do is exclusively for government. We don't have any private tenants, and see there on the top there with the first row. The other is majority all of this touches real estate in some way. Safety and properties absolutely touch that, but the community, most of that also touches real estate, where we own the facility, we provide the services. But we also do, in the community segment, do some home confinement, do some alternatives, maybe electronic monitoring and other case management services in that community segment that maybe didn't have a necessary connection or linkage to real estate. The next slide on page 5, I'm going to tag team a little bit with Dave on, but I want to do a little bit of a lead in and just talk about our earnings performance over the last almost decade. We've had really good success on providing very cost-effective but very compelling solutions to our government partners at the federal, state, and local level. And that business comes to us because we do a good job from a quality perspective, but we also produce great outcomes. And I'm often, really proud. There's many things I'm proud about this company, but one thing I'm really proud to talk about is over the last 5+ years, we've helped about 30,000 people in our care either get their high school diploma or maybe get a vocation certificate as maybe a mason, as a welder, maybe as a computer coder. And studies have shown very clearly, if you do those things, help them get higher education or get maybe certified in vocation, they're less likely to come to the criminal justice system by 40%. So really proud of that. By doing that really well, then that shows in this chart, we've had great success on providing a very strong and durable company from a cash flow perspective. But I do want to talk a little bit about, we just recently converted back to a C Corp. We were a publicly traded REIT from 2013 to the end of last year. We made the decision kind of going into early 20, going back to late 2019 about looking at our stock valuation, but also the unfortunate kind of mischaracterization about our business and concerns from an ESG perspective. I mean, our view is we are a wonderful ESG story. The people in our care get high quality, humane residential services and new modern facilities. I mean, our real estate is the newest, most modern in the United States compared to our public sector counterparts, but also we have a great history of providing really good outcomes to people in our care. However, seeing, and I think it's always important for a CEO and a CFO to look at capital allocation, seeing that we weren't getting proper valuation in the marketplace, seeing that our dividend as required of as a REIT was near 15% yield, I think it's always important for the company's management team along with the board to say, okay, is the structure today the most appropriate, or do we need to make a change? So we had a very thoughtful discussion with the board of directors over the last 18 months, and that led to a decision to go ahead and change our election from a REIT to a C Corp effective January 1 of this year. So we're very happy with that decision. Gives us obviously greater flexibility on from a cash flow perspective on what do we do with that cash flow relative to the needs of the business, or maybe paying down debt or other maybe capital allocation strategies. And it also gives you flexibility with a dividend down the road, maybe a share repurchase. So it just gives us ultimate flexibility, but also think it gives us, as a C Corp, gives us a couple of other business lines that maybe we can go into. Notably, as most of you know, publicly traded REITs can't do typically services around the medical area. So infirmaries or medical units or mental health, this conversion now lets us go into maybe other service offerings that are really appropriate and timely for a lot of our customers who are dealing with a challenge or a need for that type of solution. So that gives us great flexibility. But let me, before I go on to further, give it over to my colleague here, Dave, and take us a little more through the slide and a couple other parts of the presentation.
Yeah, thanks, Damon. So still sticking to page 5, some of the benefits of the REITs. We can see the consistent over the past 10+ years. I think we've got 12 years of adjusted Ebitda. You can see very steady cash flows of the company. But converting from a REIT to a traditional C corporation improves the credit profile of the company over the long term. As a REIT, we're required to pay out substantially all of our cash flows in the form of dividends to shareholders, but that didn't enable us to control our own destiny. So while now as a traditional C corporation, we can retain that cash flow, pay down debt, and we've got a debt reduction strategy that we think will ultimately lower our cost of capital. Also, Damon mentioned, we've been mischaracterized, and the capital markets have not been as readily available to us at the efficient costs that they were when we converted to a REIT in 2013. So converting back to a traditional C corporation and relieving us of that REIT obligation, or the obligation notably to pay the dividends, enables us to depend less on the capital markets as we're able to retain the cash flows, grow the business, and really have ultimate discretion over that cash flow. Further, we've had some large banks in the industry say that they're not going to bank the industry going forward. Again, we think that's a mischaracterization of what we do, but we've had to adapt to the environment, and ultimately that will mean we're able to operate with a smaller bank credit facility because we're able to retain that cash flow. We're not paying out all that cash flow to the shareholders for dividends. So we can lower our credit facility. We've got $1 billion credit facility that matures in April 2023. We think we can cut that in half and operate easily with a $500 million credit facility as we're able to retain those cash flows. Other opportunities that are not available under the REIT structure, as I mentioned, delevering, it will be easier to do as a traditional C corporation as we're able to accumulate that cash flow and pay down debt. We've got a targeted net debt to leverage ratio, or net debt to Ebitda ratio of 2.25 to 2.75. So targeting that decline in leverage from around 4 times where it was before we converted from a REIT to a traditional C corporation. Stock buybacks, as Damon mentioned, once we get down to our targeted leverage ratio, we'll be able to buy back tremendous amounts of stock, particularly if you look at the price today. And on this slide, you can see in the bottom right in that chart, the gray bars show that when we were last a traditional C corporation and we were not a REIT prior to 2013, we bought back $500 million of stock from 2009 through 2011 under a stock repurchase program back then. And then the ability to self-fund our growth. We're able to deploy our cash flows into growth opportunities if that's the most efficient use of our capital at the time. So moving on to current financial performance on slide 6, this does show, we're still in a COVID environment, and this period here, really COVID for us hit toward the end of the first quarter of 2020, and we're showing resilient cash flows. Notable that these numbers for the 2020 period have been restated on a pro forma basis, just implementing a tax provision at a 27.5% tax rate, which is a tax rate we expect to have going forward. So we've kind of adjusted the numbers that we reported in last year just to apply that tax rate. But after doing that, you can see our operations are very consistent, very resilient throughout the 5-quarter period shown here. Moving on to the next slide on 7, very conservative balance sheet. We had a conservative balance sheet before we converted from a REIT to a traditional C corporation. As of March 31st, we had $755 million of liquidity. That consists of $168 million of cash on hand and $587 million of availability on our revolving credit facility. We have, here you see 3.7 times debt to adjusted EBITDA. That is for the quarterly period ended March 31st, but on a trailing 12 months, it even is further down to 3.5 times. So making significant progress, and Damon will talk in a little bit about an acceleration of that delevering strategy with some property sales and that strategy, but making really good strides, taking it down from 4 times to 3.5 times in really just a couple quarters. During April, after the quarter end, so this is our first quarter investor presentation, but after the quarter ended, we actually completed a $450 million unsecured notes transaction. So we took the proceeds, the net proceeds from that $450 million. We repaid $250 million of unsecured notes that were due in 2022 and repaid about $149 million of debt that was coming due in 2023. So we've really addressed the short-term maturities, paid off our 2022 maturities, made significant progress on the maturities coming up in 2023. So really positioned the balance sheet nicely for the next couple of years, extended our weighted average debt maturity from 5.3 years to 6 years. So with that, I'll turn it back over to Damon to talk a little bit about those property sales as well as some other business development updates.
Yes, sir. Thank you, Dave. So going to slide number 9, just want to give a couple updates. Notably, as you see here with the title, sale of non-core real estate assets. So we've been conveying to the market for almost a year. I guess it was late last year we started talking about that we saw a really good opportunity in this real estate market to sell some non-core real estate assets. So we had a fair amount of what I'd call GSA type lease assets at the federal level. We did have a few state leases too, that with this real estate market and a lot of people knocking on our door, we saw really a very opportunistic opportunity, I should say, to sell these assets. And so we started in earnest kind of late last year, going out to market, getting some kind of market indication on potential pricing and interest of buying. We had strong interest. Again, a lot of people knocking on our door that was interested in buying these assets. Again, as probably everybody on this call knows, I mean, the real estate market, residential and commercial, has been really red hot here in the last 12 to 18 months. And these type of assets that are linked to really strong credit rated government jurisdictions, either with the federal government or at the local level, are even more attractive in this market. So long story short, we started the process. We were able to do a real meaningful part of this goal by the end of last year, end of 2020, as you see with this slide. And then as we indicated at the end of the first quarter, we had a couple properties held for sale that we actually got completed. So we completed the final step of these transactions right before the end of the quarter. So we announced that right before the 4th of July holiday. So we had gone into this process indicating publicly in the market that our hope was that we would generate net proceeds in the neighborhood of $150 million. And I'm very excited to say we were able to do that. So we really had a really good opportunity to kind of hit the market at a really good time. And then with that $150 million, as you see there, the punchline there is that we're looking to continue to kind of pay down debt to get to our goal of 2.25 to 2 3/4. So this is another really significant step to help with that goal to continue kind of delever the company and take down the maturities kind of near term kind of off the table as a risk. So we're really excited. Appreciate Dave and the real estate team working really hard here in the last 6 to 9 months to make that happen. One other key thing I want to touch on while we're on the slide, it's not noted, but I just want to highlight kind of one other kind of real important kind of business activity that we've got going on near term, and that is we are actively working with our customer at the federal level, the United States Marshal Service, as they comply with a recent executive order that was signed by President Biden in late January. And if you followed the company, and you've probably heard some updates that we've given on some previous calls, I won't go through the entire history, but I will indicate that we had a couple of kind of near-term facilities that were under a direct contract with the Marshal Service that were impacted by the executive order. And I'm very excited to report that we've really determined and found really good solutions for both those near-term contracts. So notably, 2 contracts that were kind of near term that were impacted by executive order. One of them was a direct contract with the Marshal Service up in Montana, and another one with Marshal Service in Ohio. And different solutions for both. And that's kind of our view as we go through this process and kind of navigate the compliance the Marshal Service have to have on an executive order. We don't think there will be one solution for all these impacted facilities. So just a quick overview on the 2 locations. Montana, what we did is the Marshal Service completely vacated from our facility that we have up in Shelby, Montana. They moved that population, as we understand it, to local facilities, so county-owned facilities that were run by local sheriffs. And with that, the local sheriffs that had state population, that population was moved to our facility in Montana in beds that were vacated by the Marshal Service. So it was really kind of a win-win. What we were able to do is provide a solution for the Marshal Service that had obviously contingent space needs in Montana to help them coordinate with local jurisdictions. But in turn, counties that had state population that really needed to be in a very intensive, strong programmatic environment, and they weren't really getting that at the local level, now they're going to get that in our facility. So it really turned out a win-win for not only the jurisdictions, but the people that were impacted by the decision that are either in our facilities or in the local facilities. So that's the solution we did in Montana. And what I'd say, and also in Ohio, in Mahoney County is where our facility resides in Ohio. So it's Youngstown is the city. And we were able to work out a really good solution for Mahoney County, the local jurisdiction, to be basically a relief valve for some of the needs that they've got locally within their county jail. This is a community we've been in since the late 90s, so they know us very, very well. They see us as a very good corporate partner. We have done a lot in the community. We also have this facility a state population from Ohio Department of Corrections. So it was another creative way where we could kind of leverage our expertise, but also our relationships, in this case with Mahoney County, where we could provide a relief valve, not only for the needs they've got maybe locally, but also maybe for the federal government. So again, what I would say is that as every step comes up on a contract impacted by the executive order, I think what we're showing here recently with both Montana and Ohio is really just being kind of the journey we've been on in 40 years, and that is being very flexible, being very innovative, work with partners as they've got to deal with maybe policies or direction or priorities or goals they want to achieve, and roll up our sleeves and figure out how we can be part of the solution. We've done that many, many times. We've done it again with Montana and Ohio, and it just reinforces over 40 years a great success of being very not only innovative but flexible to the needs of our either federal, state, or local partners. The last thing I'll touch on before we go into Q&A, and this is actually on slide number 19. I touches on this briefly, but I really want to just amplify this for a minute, and that is all the stuff that we're doing around ESG. So if you haven't already, go to CoreCivic.com. You can actually go and see our 2020 ESG report. It's a great overview, but we think not only that, it's a really great way to have a transparent view to our operations in all three business segments: property, community, and safety. So you'll see some of the highlights here on this slide. And again, this is on our website, which I would suggest you take a little closer look at. But a couple things I want to highlight. One is I just reinforce what I said earlier. We've got a tremendous responsibility, but also tremendous opportunity for people in our care. And so we've made a commitment going back to 2014, where I made a public statement, and it was carried by national press, that from me down to all of our correctional officers, reentry is a day one priority. So anybody that we have given not only the tremendous responsibility, but opportunity that comes in our facilities, give them a safe, humane, modern facility that has all the appropriate services that meet all the national standards, but also how can we help them on that journey back into the community that they're coming from. And that's maybe academic, that's maybe vocational. Of course, there's going to be some of that maybe dealing with addiction, dealing with maybe mental health or medical issues, but helping individuals that are in our care get best prepared once they do get released, going back to the community, they don't come back in the criminal justice system. So the ESG report really provides a good overview of goals that we set, outcomes that we've had. And we think if we do that really, really well, which we do, I feel really good about what we do and how we do it, then that just gives us more opportunities to provide the solutions for either existing partners or future partners. But other thing I wanted to highlight on this slide is that, one thing that we have done here recently, so a little more recent than our 2014 proclamation of saying reentry is a day one priority, we've also started lending our voice a little bit to some legislative priorities, both at the federal and the state level. That is a area that we've basically said everything around that is a non-negotiable, that we will not touch it or lend our voice to it, especially around sentencing reform. But what we did realize in this really good environment that we're seeing around the country, there's probably a few things we could lend our voice to and support and promote that are going on in state houses around the country and also the federal level. So as you see here on the slide, we've actively lent our voice on ban-the-box legislation, but we've also really made sure that people that are running for office or in office, if they're thinking about Pell Grant restoration, maybe at the federal level, or maybe voting rights restoration at the state level, licensure reform policies, that when states are considering those type of priorities, we want to be there and lend our voice in support of these really, really important policy changes. I've been asked many times here in the last probably couple of years what I'm optimistic about the business and the industry. This is one key thing. Our kind of national dialogue that's going on around criminal justice reform and red states and blue states talking about these type of this type of legislation, or restoring voting rights for formerly incarcerated individuals. That's a good thing. And if we can lend our voice and support for a governor or for legislators who are considering making that decision, then so be it. So anyway, more can be learned about the company and the ESG report, but I wanted to share those highlights. So with that, I think we'll go ahead and turn it over for Q&A.
Thank you, Damon and David. Great presentation. I am Joe Gomes, the Noble Capital Senior Analyst who covers CoreCivic. Here are the questions I selected from the audience, as well as a few of my own. So obviously the key questions here coming in from the audience revolve around the marshals and ICE. So let's start with the marshals. Maybe can you talk about what other contracts are up for renewal in 2022? In Ohio, you now kind of have a third party that you made the contract with, that they then contracted with the federal government. How does that impact, the revenues and earnings for that? And in Montana, you swapped out the marshals for local. Does that have any impact on revenues and operating income for that contract?
Absolutely, great question, Joe. And again, let me just say thank you again for you and the Noble team for having us this afternoon. So maybe we'll tag team a little bit. I'll let Dave talk a little bit about kind of the earnings performance of the kind of pre and post transitions on both locations. But what I would first say, just kind of think globally to your question about the Marshal Service, is that both the outcomes in Montana and Ohio most recently, I think, are just indicative of what we've done for 40 years. And that is listen to the voice of the customer, understand the goals that they're trying to accomplish, understand if we've got situations where we've got multi-jurisdictional interest and needs, how can we create kind of win-win solutions for everybody involved. And I'm really, really pleased in both locations we were able to do just that. Different solutions, but that's okay. And we kind of went into this knowing that there wasn't going to be a kind of one size fits all for all of our agreements. So your second part of your question is, kind of what's after Ohio and what's after Montana. So we've got a couple other direct contracts coming up later this year that would be impacted. That's one here in Tennessee near Memphis, what we call West Tennessee, and then another one in Leavenworth, Kansas, that actually comes up for expiration around January 1st. So we're in active discussions with many jurisdictions and partners about, again, how do we create a kind of a win-win for all involved for those locations. So nothing to unveil today, but hopefully kind of recent history shows with both Ohio and Montana that we've got great success to find solutions for all involved. A little later down the road, we've got two other contracts. One's in 23 and one's in 28. One's in Arizona. That's the one in 2023 expiration, and the 2025 expirations for contract Nevada. So those are several years away. So kind of near-term focus is the other two, like I said, the one here in Tennessee and the one in Kansas. But maybe add a little bit, Dave, and also a little bit about the earnings on Montana and Ohio since we transitioned.
Yeah, starting with Ohio, that was the first one we did transition. As Damon mentioned, we entered into an agreement with Mahoning County, and the county there has responsibility in their system for both federal inmates, which includes U.S. Marshals detainees, by the way, as well as county inmates. So they are using our facility as part of their system, and the economics that we negotiated with Mahoning County are substantially the same as the economics that we had with U.S. Marshal Service. There is a little bit of an upside to the extent that the populations exceed, say, the levels of 2020. Likewise, there would be a little bit of downside if populations don't return to the levels that we saw in 2020. As the disruption was occurring after the executive order, we did see some declines in the U.S. Marshals populations from some of the districts that were being told that they needed to vacate the facility. But ultimately, we do expect to see populations return from Mahoning County to the levels that they were, say, pre-executive order. So no material impact on the economics at the Northeast Ohio facility. Likewise, the U.S. Marshals had less than 100 detainees at our Crossroads facility. It's about a 650-bed facility. The rest of the facility was being occupied by the state of Montana. So we did expand the contract with the state of Montana to assume that they would take over the space that was vacated by the U.S. Marshals. As Damon described, it was kind of a detainee swap. The Montana inmates went to our facility, and then the U.S. Marshals detainees went to the capacity that was created by the swap of the Montana inmates. So Montana is committed to using that full 650-bed facility. They have an urgent need to use the full facility, and so the economics will basically replace the cash flows that we were generating from the U.S. Marshals for those less than 100 detainees. So at the end of the day, we're really, really pleased that we were able to replace the cash flows from both of these transitions from both facilities, and would expect that going forward. Certainly don't know that for a fact, but that would be the objective going forward as we're discussing the West Tennessee facility and the Leavenworth facility, both of which expire later this year.
Great, thanks for that. So let's switch over to ICE for a second. The most recent data show ICE populations continuing to increase. They were so far in July, the average daily population is up over 27,000, which compares to a little over 14,000 in February. How's this impacting CoreCivic's business and occupancy levels? How close is the company to getting above the contract minimums?
Yeah, so we'll tag a team again on this one, Joe. What I would say is that, as you know, but for the benefit of the audience, the majority of our facilities and capacity that we provide our ICE are primarily in the southwest border. We do have some facilities for ICE in places like Mississippi and Georgia. But what I would say generally, and we've kind of seen this trend since versus this year, is that there's been increased utilization noted by the number you just shared with the overall kind of global number for ICE. So we've seen, I'd say consistent, I don't know if you'd say it's parallel, but it's pretty consistent with the increased utilization in our system. It's pretty consistent with what ICE is reporting kind of globally, what they've got as a total population nationwide. Again, what I also say is that we're very proud and thankful for the opportunity to provide these solutions for ICE. Again, our focus is on providing high quality and cost effective. So again, our ICE facilities are the newest, most modern facilities in the country. But I should also reinforce what's unique about our facilities versus maybe other solutions that ICE considers maybe at the city or county level, is we try to make it really a turnkey solution, not only just with our leadership staff down to the front line, but also we provide a lot of space and square footage for courts, for attorneys, for case managers. And then actually there's a lot of government oversight that work on site to provide oversight and make sure we're in compliance with the contract and the standards. So we think that type of environment to where it's more efficient for their mission and some of the needs they have on the southwest border, but also the additional space that we provide not only for their government staff, but for the oversight, makes it a really kind of value-added solution. So we continue to see that this solution resonates as we go into the first half of this year, but maybe add to that, Dave.
Yeah, I'd say, during the pandemic, those populations declined too. And I think that's part of where you were going, Joe, with the fixed payments that we receive from ICE. And during the pandemic, under the Trump administration, asylum seekers would be turned away at the border rather than coming into the United States and getting their due process and hearing their immigration hearings. That policy called Title 42 has been extended during the Biden administration. And that has resulted in a decline really sequentially, every quarter sequentially, starting with probably the second quarter of 2020 through the first quarter of 2021. We would anticipate at some point that policy, Title 42, to be lifted, whether that's third quarter or fourth quarter. We would expect it to be one of those two quarters. And at that point, there'll be some the undocumented immigrants would be allowed into the United States until their immigration hearing is held. So we do expect to see a proportionate increase, as Damon mentioned. You mentioned, Joe, that the populations that you mentioned are nationwide, not necessarily our populations, but we have a percentage of that total population. And as those total populations do grow, we would expect our populations to grow somewhat proportionately. With respect to the fixed payments, what you referred to as guarantees, I mean, those guarantees are in place for just this type of a situation to ensure Immigration and Customs Enforcement that they have the capacity in the event of a surge. The population levels dropped in 2020 were really unprecedented. We haven't seen that level of decline in decades. So at least the nation hasn't, and our populations really proportionally were down as well. So they wanted to maintain that flexibility. ICE, I'm talking about the agency, wanted to maintain the flexibility to make sure that they have a surge, they had the access to beds that we provide. And so we were probably a few thousand detainees below those levels during the first quarter. And we're getting closer to those levels now, and would expect them to be higher than that level really probably beginning in the third quarter. They're normally, historically, they've always been above that level, but it's really just been in place to ensure that they have the capacity, as I mentioned.
Thanks for that. So you did mention about the sale of the non-core properties and the exceeding the 150 million net goal. At this point in time, are you planning on using all those proceeds to reduce debt, or are there other things that you might look at with some of those proceeds?
Yeah, great question. And the short answer is it's focused. We're laser focused on the debt and bring the leverage down. Obviously, we've got day-to-day capital needs for the business for preventive maintenance, whatnot. So obviously, we'll have some dollars that need to spend on that. But as we think about other alternatives for capital deployment, either building a new facilities or expanding of new facilities, or we've been a pretty active M&A acquirer, I should say, in the last probably 7-8 years. Those things are out there, but I'd say they're right now low priority and really not really any meaningful opportunities. I mean, to the point I was just made about utilization. I mean, we've got a lot of vacant capacity within our safety side and even our community side where we don't need to deploy any capital. And like I said, on the M&A side, we've turned that spigot off for the moment. So the dollars that we get from cash flow, and then dollars, like I said, we gotten from these sell these non-core assets. It's our laser focus at the moment to take down the debt maturities as appropriate and lower leverage. But anything you'd add to that, Dave?
Yeah, really, that's the number one priority for us is debt reduction, and that targeted leverage ratio that I mentioned earlier, 2.25 to 2.75. Depending on how quickly we get through the pandemic, and it does seem like things are getting back to normal. They're certainly not back to normal yet, and they may lag in the criminal justice system. Just to see the backlog of cases, it may take some time before we really see things return to normal there. But we're estimating we would get down to our targeted leverage ratio probably by the end of 2022, plus or minus a quarter. So that's really the focus of the cash flows that we generate. It's the focus of the net proceeds that we generated from those asset sales. We will. I mean, we have repurchased some of our debt, and then next question might logically be, which debt would we reduce? Which debt would we repay? Really focused in on the credit facility in the short term. But as I mentioned, through the bond transaction that we issued in April, we did take out $149 million of our 2023 notes. And we'll look. There could be opportunities in the marketplace to repurchase some of those notes. Those notes do have a make-whole that would be in place through 2023. So we obviously would prefer to avoid paying a make-whole. So we expect to generate sufficient cash flow to be able to pay those notes off in 2023. So between now and then, could there be opportunities to repurchase some of that debt in the interim? We'll look for those opportunities. If there are, we'll take advantage of them. The credit facility does mature in April 2023. We've already started, we mentioned on the past couple calls, we've started thinking about timing of when we would want to amend and extend that credit facility and what form it would look like, speaking with our banking partners about their interest in extending and their interest in participating in it. Been speaking with some new banks too, but feel good that we've really positioned the balance sheet, as I mentioned in our prepared remarks, to really rely less on the bank markets, rely less on the capital markets in general. So we feel like we're in really good shape going into the amendment extension, or the discussions for that amendment extension. And our balance sheet from a credit perspective is only getting stronger as we continue to pay down debt. We think the combination of those things, along with the access to capital that we demonstrated through the bond issuance in April, will really serve us well in the execution of that amendment and extension. So that's where that cash is going toward in the interim to pay down that debt.
Thank you. You know, can you talk a little bit about the Alabama opportunity? You know, it was something that was, you know, you had talked about in the past. You know, then you had the whole issue with the financing and the withdrawal of the underwriters. You know, where does that stand today? You know, how do you model going forward, overcoming, you know, what happened with the underwriters in this instance, and what other opportunities are you looking at, and has the delay in Alabama caused any of these to slip?
Yeah, great question. Again, we'll tag team on this question, Joe. But let me just say, we really have followed the lead of the governor and the commissioner of corrections on kind of any public statements on Alabama. So I will kind of parrot a little bit what they've said here in the last probably 30 days. One of which is, I mean, they are laser focused on reforming and transforming and modernizing their correctional system. And if there is a path forward with working in the private sector, and as you know, we've put together a very viable solution with a whole team of developers and contractors and others to provide a solution that helps them transform, but also we think the most cost-effective and most efficient way. So it's unfortunate some of the the bumps in the road that's happened in spring and summer that we've talked about with some of the partners we've had on the transaction itself and delivering these facilities. But it's clear, and I've heard this again in the last 10 days from public statements from both the governor and commissioner, they are laser focused to get this done because it's the right thing to do, but that's the most important thing. But secondarily, as you know, Joe, I mean, they're in an active litigation with the Department of Justice to modernize their system. So they have no alternative. They have to do this. And again, what we think we've put on the table is that it's the most efficient, it's the most comprehensive and cost-effective way for them to do it. So we know that the governor and the commissioner in some recent comments, they are evaluating maybe some alternatives that the legislature is proposing. And so obviously we respect that and appreciate that. But we want to continue to be there at the table with them as they think about maybe new alternatives or different kind of ways to get the ultimate goal, which is again to modernize our system. We think what we've put on the table continues to be very, very compelling. So more to come during the summer months, but I would also just say the conversation with Alabama, it is very frequent. It's probably daily, if not multiple times a day, as they kind of navigate through how do they get some of these solutions across the finish line and ultimately get some new facilities out of the ground. For the benefit of the audience, let me just give you a high level. Alabama Department of Corrections is about a system with about 20,000 individuals on a given day. Their rated capacity is 10,000. So 10,000 capacity, 20,000 population. So quick math, they're double their capacity in their system. And with that, many of these facilities that they're housing individuals today, they're up to 100 years old. So they're past their useful life. They've got system failures. I mean, it's been well documented, some of the challenges they've got in Alabama. So that's led then by this court action and engagement by the federal government and the Department of Justice. So again, I'll tag team with Dave on this, but the kind of last part of your question is, and Joe, you and I have talked about this. We've estimated that there's up to 100 to 150,000 beds nationwide that are in facilities that are up to 100 to 150 years old. I mean, very, very old facilities. As you know, we did a modernization similar to Alabama, Kansas a couple of years ago. And, things I hear over and over again from governors, but more notably with directors and commissioners of corrections, they know what they need to do. They know what they've got from a challenge perspective, what they've got to accomplish. They just, for whatever reason, can't get it done. So what I've continued to believe, based on what I'm hearing kind of live from the market, is what we've done in Kansas, what we hope to get done in Alabama. This is a path that makes a lot of sense. And again, in many cases, if not all cases, it's the most efficient way to get it done most quickly and to quickly transform their system. And again, the most important thing is by doing that, it modernizes their system. It's a better, more safe, more humane environment for the individuals in their care, but obviously it's a safer place to work for staff. But maybe David, let you add to that.
The only thing I'd add is, from a financial perspective, we were pursuing a financing for the construction of 2 facilities. So we've signed 2 lease agreements with the state of Alabama. We signed them, I think it was February 1st. And after the hiccups that we had with the financing, and now the governor is, as Damon mentioned, involved in the legislature, and we're taking the lead of the Alabama government, including the governor, on which direction they want to take. But we're ready. We've engaged financial partners, so we're all set and ready to go. Just awaiting the direction on which way Alabama wants to go with the construction of new facilities, which, as Damon mentioned, they're so desperately needed. They have to do something to address their challenging situation. And it's a little mind-boggling to think that status quo is acceptable for the opponents that were opposed to the financing of 2 new facilities that will provide natural lighting, programs and services, and extra space and air conditioning and great amenities for not just the inmates in their care, but the staff. And they'll be able to retain and recruit staff much easier in better conditions. So we think they're going to move forward. We'll take their lead, and we stand ready to go, and we are ready to go.
Thanks for the update on that. So let's take one here from the audience here. They're wanting to know if you are going to share any forecast for revenue and EBITDA for 21 and 22 pro forma for the asset sales, and combine that with another question is, why has EBITDA margin been on a downward slope, and what are you doing to remedy that?
You want to tackle that one?
Yeah, we suspended our guidance last year when COVID hit. There were so many uncertainties with what was going to happen during the COVID environment. We've largely made our way through those uncertainties. Then we had the executive order by President Biden in January that created another element of uncertainty, not just with the executive order that he issued, but around immigration policy. And so we've kind of withheld guidance and reinstating guidance based on those uncertainties, which I think we're getting to the other side of what that looks like. And I think we'll be in a position, pretty sure we'll be in a position this quarter to reinstate guidance in connection with our second quarter earnings release. It's a conversation we want to have with our audit committee and the board as well. But we're getting, as time goes by, we're getting more clarity on where things are shaking out and the kind of the bookends of where things are going. So I think we'll be in a pretty good position to reinstate guidance. With respect to margins, I think they've actually held up fairly well, particularly during COVID. We no doubt incurred COVID-related expenses for personal protective equipment and additional time off for staff and PTO and things like that. But also at the same time, we did, have a lower level of services that were required in our facilities because, unfortunately, a lot of those programs had to be suspended. Visitation was curtailed and things like that didn't require us to staff up as high as we would during, quote, normal operations. So we do expect those things to return. Wage increases, I'm sure you're hearing about it with many of the other companies that you covered, Joe. But finding staff, that's probably our number one challenge right now is finding qualified staff. The labor market is challenging. It's particularly challenging for our industry. It's a very difficult job, and I have nothing but admiration for the correctional officers that stand their post every day. It's a tough job, and so that just makes it more difficult to recruit and retain staff, and that has an impact on wages. And we just provided wage increases to the majority of our staff effective July 1st, so that will impact the second half. That's what we do every year. I'd say this year they were higher than what they've normally been, just because of the challenging labor market. I don't know if you've got anything to add to that.
No, that's perfect. That's perfect.
So let's take another one from the audience. What future risks with the current administration most concern you?
Well, I'd say it's probably a great question. I'd say it's probably what we talked about earlier with the Marshal Service. So we're right in the middle of that. So the good news is that the Marshal Service and also other government partners like Montana, Ohio, or Mahoney County in that case with Ohio, we're collaborating. We're talking about solutions. We're talking about maybe ways where we can help the Marshal Service again comply with executive order, but in turn we can help them with other provider, or help them maybe with the solution in Ohio where they're already partnered with a county for space. So I think that, that's obviously a key priority and focus for us in the coming days and weeks as we think about again the two other contracts we got into this year, and then we've got the one in 23 and 25. But what's encouraging to me is, again, and it happened in Montana, Ohio, but we've done this for 40 years, and that is we've got the ability as a private sector to be innovative, to be flexible, but also we have a really great network of existing or new partners that maybe could be a solution for a government partner, in this case be the Marshal Service, or maybe provide a kind of alternative solution like we did in Ohio with Mahoney County. So I feel good about the recent success. It just again reinforces the record we've had over 40 years to be again flexible and innovative. So I think as we continue, and as I said earlier, I don't think it's going to be one size fits all. I think every solution is going to be a little different by facility location, and again the needs of the collective jurisdictions that are maybe impacted by that decision. But I'm really encouraged that we've had great success on the most near-term two direct contracts were impacted. We've really created great outcomes for all involved in those solutions. With ICE, we talked about that earlier. One thing I guess I would note for the audience is that we have been working with ICE for almost 40 years. In fact, our very first agreement, which was formerly INS in Houston, Texas, back in 1983. So we know that agency very well. We know that they need flexible, innovative solutions. And we also know a solution today may not be the solution they need tomorrow. So we've also been able to be very, very quick and nimble to kind of recalibrate based on the needs and priorities of the administration, if it's a Republican or a Democrat in the White House. So I think we've done that very, very well. But also I'd point out again for the audience is that in 2016, under President Obama, there was a very detailed review about ICE's use of the private sector for detention capacity. And the bottom line of that, which was about a 6-month review, and it had a blue ribbon panel of people kind of all ends of the political spectrum to do tours. They held hearings, which I actually got to testify on one to talk about our partnership with INS. They talked to opinion leaders. They talked to people within the industry that set the standards. The punchline of all that review after 6 months and all these tours and hearings and meetings and whatnot was that we are a very, very good viable solution for ICE for their detention capacity. And so that was a very, very strong statement that, it kind of reaffirmed what we felt like we knew, but it was nice to have it confirmed by a third party that we were very effective on that. So we think that, as we continue to go into this new administration, we do what we do. We can control what we can control, which is high quality, meet the standards, cost effective, but also continue to be kind of nimble and innovative with our government partners based on changing needs that they may have, but also maybe shifts in policy. But anything you'd add to that, Dave?
Just that I'm excited about the opportunities. I mean, I have been so impressed with our company, with the ideas, the creativity that we've brought to the table for our government partners and how we can help them fulfill their missions. And the various structures, we've just put so many things on the table that we think are really good solutions, and it could change the dynamics of the company. I mean, we've talked about leasing facilities before. Could we lease to government agencies and take advantage of the real estate that is really the critical component that our government agencies use? And so there's various uses of that, whether we're the operator, whether we're just the landlord. And so just the tremendous number of opportunities and creative ideas that we've been able to generate as a company has been very, very impressive to me, and pretty receptive by our government partners. But ultimately, we'll see where they end up.
Thanks for that. Let's finish up with this one, guys. It's been a great call here and a great presentation. What remaining milestones should we look forward to by year end?
Well, let's tag team on this one. I would say, again, going to one of our key priorities, and that is paying down debt. So obviously, got to manage the day-to-day business, get us, through the kind of the tail end of COVID. We feel like, as Dave said earlier, that we're kind of like the general public and what you see in the communities, which is with the vaccinations widely being disseminated, high vaccination rates, feel like we're getting on the other end of that. So getting through that, taking care of the day-to-day stuff with the business, with that, making sure that, cash flow being reallocated with the conversion to a C Corp, that we're continuing to work on our goal to pay down debt. And also with it, I'd just say kind of near-term kind of business opportunities, as Dave alluded to. I mean, we are seeing now, I think, kind of signs that, jurisdictions, as we get to the other end of COVID-19, that solutions that we saw manifest in 2018 and 2019 are now starting to kind of reappear again, either with existing jurisdictions or newest jurisdictions. So I wouldn't be surprised potentially by the end of this year we get a new contract or two, maybe with some state jurisdictions that now who feel like they're a place to go ahead and maybe move forward on dealing with some overcrowding, maybe modernization. One thing we didn't talk about on this call, but I also would highlight, COVID-19 really exasperated, and I should say put a bright light on some of the challenging facilities these state jurisdictions have, because maybe their infirmary beds are 100 years old and they weren't able to effectively to quarantine or separate individuals that were positive cases with COVID. So that could be a little bit of a catalyst that they see us with our newest, most modern facilities in the United States, looked at us provide a solution. None of us hope, obviously, we never have another pandemic like we just lived through, but it did show that maybe some systems maybe who were reluctant to think about taking any proactive steps to kind of deal with those challenges going forward, maybe this is a tipping point for them. But anything to add to that, Dave?
Yeah, I mean, we've had a really good year. If you think back at the beginning of the year, kind of the goals that we set forth, we've accomplished a number of them, at least, thinking about the debt maturities that we had in 2022, trying to address those. Now we're planning on generating sufficient cash flow to pay those off, but we found the opportunity to avail ourselves of the capital markets and demonstrated access to capital. So we went to market only trying to raise $250 million of debt to repay the 22 maturities. We ended up issuing $450 million. So very pleased with demonstrating the access to capital that we did. So check that box. Address the 2022 maturities. Check that box. Even started chipping away at the 2023 maturities. We had set forth really in August of last year a goal of generating $150 million of net proceeds from asset sales. We sold 42 assets in the fourth quarter of 2020, and then this year sold the remaining assets, generating over $150 million in net proceeds after the repayment of debt and defeasance costs and so forth. Then we had the executive order and some challenges of what's going to happen with our Northeast Ohio contract and our Montana contract at Crossroads. And we were able to sign 2 new contracts, or at least extend one contract and sign a new contract with Mahoning County that basically replaced the cash flows from those facilities. And here we are in July. So we've accomplished a large part of our goals for the year, and we're only halfway through the year. On my checklist, I've got the credit facility. So I mentioned that matures in April 2023. I mentioned, we've already started thinking about and having discussions and strategy sessions about how to address that maturity in April 23. Whether we do that later this year or very early 2022, I'm not certain yet, but we're formulating strategies and having conversations, and that seems to be going in a good direction. So it's been a good year so far. As far as metrics that go for the rest of the year, we're in good shape, and paying down debt, whether that's $225 million, $250 million worth of debt, depends on cash flows for the rest of the year, in large part. But we're really satisfied with the progress that we've made, bringing net debt to Ebitda leverage down to 3.5 times. That's using the trailing 12 months as of March 31st. That could be 3.25 to maybe even 3 times by the end of this year. So making demonstrated progress toward that 2.25 to 2.75. So I'm pleased now with where we are. Obviously, never taking our foot off the gas, and we've got half the year left to go. So we'll see what we can accomplish.
I would agree with the previous statements there, David and Damon. And that's all the time we have for today. I want to thank you for helping us to get a better understanding of the CoreCivic story. If you'd like to get the independent research I've written on CoreCivic, go to channelchek.com and type in the company name or the ticker CXW in the search box in the top left company data.
Thank you for
section.
joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and microcap companies.